Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of how sustainable investing shapes the future of our planet and economy. Investing isn't just about returns anymore, it's about responsibility. With climate change, social equity, and corporate accountability under scrutiny, ESG, environmental, social, and governance, investing has taken center stage. People and organizations are asking tough questions. Where is my money going, and what kind of world is it building? As this trend grows, it's reshaping how we think about both finance and the planet's future. In this video, we'll unpack the impact of ESG investing and why it matters now more than ever. What is sustainable investing? Sustainable investing is changing the way we think about growing wealth. It's not just about financial gains anymore, it's about aligning investments with values that support the environment and society. Picture this. Your money isn't just sitting in a stock, it's actively contributing to a cleaner, greener world. This shift matters because every dollar can influence the kinds of industries we build for today and tomorrow. Definition of sustainable investing. Sustainable investing focuses on making financial decisions that consider both returns and the broader impact on people and the planet. At its core, it means putting money into companies, projects, or funds that prioritize environmental, social, and governance (ESG) criteria. On the environmental side, this could involve investments in renewable energy, waste reduction, energy efficiency, or clean water initiatives. For example, think of solar energy companies developing panels that power our homes without polluting the air. Socially, it could mean supporting businesses with strong workplace practices or companies promoting diversity and equity. For governance, it often involves choosing companies with ethical leadership and transparent decision-making processes. What sets sustainable investing apart from traditional investing is its dual focus. While it seeks competitive financial returns, it also aims to solve issues like deforestation, excessive carbon emissions, or plastic waste clogging oceans. It's investing with a purpose, not just a profit margin. Key players in sustainable investing. Making sustainable investing mainstream didn't happen overnight. It's the result of collective efforts from several key players, each shaping this movement in unique ways. Institutional investors. These are the heavyweights, pension funds, endowments, and asset management firms. They manage billions, sometimes trillions, of dollars and drive change by prioritizing ESG-compliant companies. Big names like BlackRock have committed to sustainability, influencing entire industries to rethink their practices. Retail investors. That's regular folks like you and me. Many individual investors are now demanding portfolios that match their values. Mutual funds, ETFs, and apps like Betterment and Wealthsimple offer ESG-friendly options for anyone looking to get started sustainably. Governments and policymakers. Laws and regulations play a massive role. Governments worldwide are offering incentives for renewable energy projects, carbon reduction initiatives, and stricter rules on greenwashing when businesses falsely claim eco-friendly credentials. These policies create a framework that encourages sustainable investments. This collaboration is reshaping where money flows. Diverse players in the finance ecosystem are working together with one common goal: to ensure that investments don't just grow portfolios but also grow a more sustainable future. By working together, they're proving that financial success and environmental responsibility can go hand in hand. Climate change and investment practices. Climate change is more than just an environmental issue, it's an economic force driving major shifts in the investment world. Decisions about where to allocate capital increasingly depend on how industries and companies address their environmental impact. For investors, this is both a call to action and a chance to rethink traditional practices. Let's break down the impacts of divestment, the rise of green investments, and the regulatory frameworks shaping this space. Carbon-intensive industries and divestment. The move away from carbon-heavy industries like fossil fuels is picking up speed. Divestment, selling off stocks, bonds, or investment funds tied to these industries, is more than a moral stance, it's a financial strategy. Why? Companies reliant on coal, oil, and gas face mounting risks as regulations tighten and renewable energy alternatives gain ground. When major institutions, like universities or pension funds, divest, they send a clear signal to the market. This reduces the capital available to fossil fuel companies and pressures them to adapt or innovate. For instance, coal stocks in many portfolios lost significant value over the past decade due to declining demand and increased environmental scrutiny. But what does this mean for your investments? Divestment doesn't just impact the environment, it can also affect returns. As more investors abandon carbon-intensive stocks, money flows toward industries with cleaner futures. While some argue that this strategy might initially lead to volatility, many funds focusing on ESG principles have shown competitive, long-term performance. Green investments and their growth. Green investments are booming, and for good reason. Sectors like solar, wind, and energy-efficient technologies are now at the forefront of the global economy. Solar energy costs, for example, have plummeted by over 80% in the last decade, making it not only sustainable but also extremely cost-effective. This isn't just about the environment, it's about opportunity. Renewable energy and green tech companies are delivering real financial returns while addressing some of the world's most pressing problems. Think about this. When you invest in wind farms or companies creating electric vehicle infrastructure, you're not just betting on a profit. You're helping reduce carbon emissions and dependence on non-renewable resources. Current trends support this growth. Global investments in renewable energy sources hit record highs in recent years, with governments, businesses, and individuals pouring capital into clean energy startups and established players alike. This surge reflects increased demand for eco-friendly solutions from consumers and stricter environmental policies worldwide. If you've been looking for industries positioned for both innovation and resilience, green sectors are an obvious choice. Regulatory frameworks supporting green investments. Governments and international agreements are playing a pivotal role in reshaping investment strategies. Take the Paris Agreement, for example, a landmark international accord aimed at limiting global temperature rise. By setting carbon reduction targets, signatories are effectively pushing businesses toward sustainable practices and renewable energy use. On a national level, subsidy programs, tax incentives, and clean energy standards make green investments even more attractive. Think of these measures as a financial tailwind for companies that prioritize sustainability. For investors, this means projects like solar plants or energy-efficient real estate developments come with built-in support, reducing their risk and enhancing potential profitability. In some regions, regulations go even further by penalizing high-carbon activities. Carbon taxes and cap-and-trade systems create financial consequences for companies exceeding their greenhouse gas limits, encouraging them to clean up their operations. These policies not only curb emissions but also fuel investment in innovative, low-carbon technologies. Simply put, global and local regulations are creating fertile ground for the growth of climate-conscious portfolios. By blending the power of policy, market trends, and public demand, the financial system is being reshaped to support a more sustainable future. So, whether you're an individual investor or part of a larger institution, the message is clear. Green investments aren't just good for the planet, they're good for your portfolio. Environmental risks in unsustainable investments. When investment decisions fail to account for environmental consequences, the damage can extend far beyond short-term profit. Unsustainable investments can wreak havoc on ecosystems, accelerate climate change, and leave future generations footing the bill. As the pressure grows for businesses and investors to act responsibly, disregarding environmental risks is becoming a liability, both financially and ethically. Let's explore how poorly planned investments have fueled environmental crises, and why turning a blind eye to these risks can backfire economically. Examples of environmental degradation from investments. Some industries have left deep scars on the environment due to investment choices that prioritized short-term returns over long-term sustainability. Here are a few major offenders. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.